So going back to this, right? Now we're learning about the balance sheet. We know that on the balance sheet should show a list of all of your assets, liabilities, and your equity, okay? Here, we know for a fact that the balance sheet's going to have allowance for doubtful accounts because it's a contra account to your accounts receivable. Accounts receivable is your asset. So it for surely will appear on the balance sheet. Now, let's go ahead and read the scenario. If a company, okay, estimates that $25,000 of it out of its $500,000 accounts receivables is to be uncollectible, okay, and there is currently a debit balance of $5,000 in the allowance for doubtful accounts, okay, so journalize this adjustment. So here's three key factors. So in the very top corner up here, the best way to memorize this is that when you see the estimated amount, which is the $25,000 out of the $500,000, right? That's your total amount of accounts receivable, right? If you're predicting that $25,000 of those dollars are to be uncollectible, right? You need to recognize two things. If it's accounts receivable, then you're using the balance sheet method, right? You know for sure that there is an allowance for doubtful accounts account. So with that being said, therefore, we currently have a debit balance of $5,000. This debit balance is going to be very important, okay? Especially when you're dealing with your account receivable because you already have a contra account right there. And the one thing that you have to also know too is that you currently have a debit balance, okay? Now, if there's a balance in the allowance for doubtful accounts, this is what you need to do. If it is a debit balance, you need to add that amount to your estimated amount. If there's a credit balance, then you need to subtract that amount from the estimated amount. So in this case, what I'm actually entailing here is that when I'm making this estimated amount, right? This estimated amount means that means at the end of this adjustment, I need to have $25,000 in my allowance for doubtful accounts at the end of the day. So if there's currently a debit balance, right? So if I'm on the left side by 5,000 and my end goal is I need to be on the right side 25,000, how much do you need to get to the balance to become zero?
We're at 8,000?
Well, right now we have 5,000 on the left side, right? We have a debit balance of 5,000. How do I get to zero?
By crediting 5,000?
Correct. Now my end goal is I need to have a total of 25,000 on the credit side. So how many more do I need to go to the right? I have to go 25,000,
right?
Correct. So in this case, because I have a debit balance, I need to add these two numbers together. So because I have a current debit balance, I'm on the left side, but I need to be on the right side. Therefore, I need to add these two numbers together to get me my total ending balance to be $25,000 in my allowance for doubtful accounts. So in this case, the journal's going to look like this. Obviously, it's a bad debt expense. It's an expense account. And that's what I'm going to write off. My allowance for doubtful accounts is where I'm taking that amount from and I'm writing that off as well. So in this case, if my end goal is to get $25,000 in my account allowance for doubtful accounts account at a credit balance. Therefore, because I have a debit balance, I need to add those two numbers together to get a total of 30,000. Okay? So here, if you not really following along, you're just not understanding, the best way to look at this scenario is you're going to look for three key things. You're going to look for your estimated amount. So in this case, number one, what is your estimated amount? 25,000. Second thing is the keyword that you're looking for is accounts receivable. Boom, right there. It's out of the $500,000 of accounts receivable. Third thing is you're going to recognize, what is your account balance? I currently have a debit balance. Boom, I need to add that number to my estimated amount. So in this case, there it is. It is $30,000. So once again, once we deal with our ledger, this is going to make a lot more sense because when you have a running balance, if you have $5,000 on your left side and you need to get to your right side, 25,000, you're going to have to backtrack, right, to get to zero and then to get to the remaining amount. Okay, so remember, it's like that, the number scale, right? You got your positive number, you got your negative numbers. If you're already positive, how do you get all the way to the negative? Okay, you need to backtrack to get to zero, and then you need to add whatever amount so you can reach your end goal. Okay, so far, now a lot of students ask me this, well, where do I get a balance in my allowance for doubtful accounts? We just learned that like 2 minutes ago. When we're dealing with our customers during the period, right? Just like that Mr. Sanchez, he bought something from me, but then he decided to fault on his payment. That happened during the year, and that's why I have a debit balance in my allowance for doubtful accounts. Okay, so once again, this happens at the end of the year, typically. So once again, how do I get a balance in my allowance for doubtful accounts? It happens during the period when a customer or one or more customers decides to either pay you or they decides to not pay you. You're going to put that amount in the placeholder. Once you've reached the end of the year, you're going to take that placeholder and you're going to assume, well, it's been a whole year. This person hasn't paid me yet. So what I'm going to do is I'm going to write them off. Okay? So this 30,000 includes the $5,000 that whoever person didn't pay me. Okay? Is everyone okay so far? We're going to do another example. Okay? So example number 2. All right? If a customer, if a company, right, decides to, it estimates that $25,000 of a $500,000 accounts receivable is to be uncollectible. There is currently a credit balance of $5,000 in the allowance for doubtful accounts account. How are we going to record this adjustment?
It's going to be the opposite. It's going to be 20,000.
Correct, right? Because few key factors, right? Because there's already a credit balance in my allowance for doubtful accounts. I'm already $5,000 on to the right side. I only need to get to 25,000. So in this case, you're going to subtract the two numbers, right, to find the difference, and then your answer will be 20,000 because you're already on the right side, 5,000. How many more do you need to get to 25,000? That's the key goal here. Okay. All right. Is everyone good with this balance sheet method?
Yes.
Okay, once again, I wouldn't go super into detail unless you are the person that's going to be in charge of accounts receivable. But once again, this is just general rule of thumb. Usually, typically, you wouldn't be the one that's doing this unless you are the accounts receivable, you're the debt collector of the company, and you're doing that accounting position. But for most general things you need to know is that if you do have these kind of things that you need to know, it is that when you already currently have someone that owes you money, and you for sure that they're not going to pay you back, you can just write them off completely. Okay? So now I'm going to introduce you to the income statement method. All right? So when we take a look at an income statement, right? The income statement only comprises of your total sales, your cost of goods sold, and all of your operating expenses. Nowhere on the income statement will you ever see the allowance for doubtful accounts. So therefore, general rule of thumb is that if your company decides to just make an estimate of your total sales, your only assumption is that whatever the balance in the allowance for doubtful accounts, you don't care about it. Okay? All you care about is just the estimated amount. So if that's the case, then let's take a look at the scenario here. If the company estimates that $25,000 out of its $500,000 total credit sales is to be uncollectible, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts, how do I record this adjustment? Okay. The journal will look identical. The only difference is the calculation, right? Bad debt expense, there's only one expense account for that. Just it's general, bad debt expense. And where are you going to take it out from? Because we're using the allowance method, you're only going to be dealing with your allowance. That's the only place you're taking it out from. Okay? So, in this case, how should I journalize this adjustment?
It's just gonna be for the 25,000.
Correct. Right? Because, so here's up here in the top right. We have to look for two things, right? First thing is what is the estimated amount? 25,000, right? Second thing is the key term, total credit sales. Once you see that, you stop there, you don't read the rest because you don't care about the allowance for doubtful accounts. It doesn't appear on the income statement. And if it doesn't appear on the income statement, then all you care about is just the estimated amount. So in this case, it is just strictly 25,000. Okay? Now, once again, yes, the allowance for doubtful accounts is indirectly related to your sales because, your sales could comprise of both cash and accounts receivable. But in this case, we can't assume that all sales are going to be purely cash or purely accounts. So in this case, this is a total credit sales, right? Total credit sales. We're assuming that out of the credit sales that we have, we're going to assume that all of these are just going to be, we're never going to collect the money from them. So that's just all that is saying. So in this case, we don't care about the allowance for doubtful accounts. We only care about the estimated amount, and boom, it is 25,000. Okay. So let's try scenario number 2 once again. If it is estimated that 25,000 of its $500,000 total credit sales is to be uncollectible, and there currently is a credit balance of $5,000 in the allowance for doubtful accounts, how am I going to write this adjustment?
It would still be for the 25,000.
Good. Because once again, we don't care about the allowance for doubtful accounts. It doesn't appear on the income statement. All we care about is what the estimated amount is for. So good job. All right. Any questions about how to write off bad debt properly?
one question.
Go for it.
Okay, so on the income statement method, are we journalizing this in the income statement?
What is the income statement?
Well, no, I mean, I heard you say before that you'll never see the allowance for doubtful accounts in the income statement, but yet this is named the income statement method. So I was just wondering.
Okay, so income statement method is just you're just taking the income statement and you're just seeing what the values are. Same thing with the balance sheet, right? You're only seeing what the values are that appear on it. You will be writing the journal no matter what, but it's just asking on if you're looking at the income statement, right? If you're using the income statement to write your journal,
Mhm.
that's what you're going to be utilizing, right?
Oh,
Your
okay.
total credit sales.
Okay.
You're not going to write a journal directly to the income statement. No.
Okay, that's what I wanted to clarify.
Okay. Nicole, you had a question? Or Melinda, did you have a question?
No, I'm good.
Okay. So that is how we write off bad debt. Okay. So chapter review, once again, we got to take a look at what happens when we're dealing with receivables, right? We recognize that we are owing, or our customer's going to owe us money, right? By buying things from our store and we're placing it on an account. Now, during the period or during the year, right? As your customers can make their payments and you notice that some of these customers are not making their payments, therefore, you need to make a journal to record that this person isn't going to pay me. And you know exactly who, you know exactly how much, and you know exactly when, right? Obviously, whoever is owing you the money, you're going to know who, and you know how much, and you know when. Okay? So therefore, you're going to create the contra account so you can use it as a placeholder, because the one thing that you need to know here is that you could potentially get that money back. Right? They could pay you back. But if you are for sure and it's at the end of the year, that's where we're going to go ahead and make our adjustment for the bad debt expense. Now let's go ahead and go into the right side. There are two methods of writing off bad debt. We got the direct write-off method and we have the allowance method. The direct write-off method is only for tax purposes only and used by tax accountants for the purpose of the IRS. Okay? There's a lot of more mumbo jumbo that needs to go into that, but you just strictly need to know that only portion. That the direct write-off method does exist, but only the tax accountants can do it. Okay? So therefore, we're going to be focusing on the allowance method, right? Only dealing with the allowance for doubtful accounts. So in this case, it's used for regular accountants. It's governed by GAAP, okay? Now, the allowance method splits into two different methods. It splits into the balance sheet method and the income statement method. Once again, the balance sheet method will show your assets, which is your accounts receivable, and it will also show the allowance for doubtful accounts on the balance sheet. Okay? So then, if that's the case, there are three things you need to focus for. You need to focus on the estimated amount. You need to make sure that the word or the term accounts receivable appears. And then you need to determine what is the balance. If there's a debit balance, you're going to add that to your estimated amount. If it's a credit, you're going to subtract that from your estimated amount to determine the journal. Okay? And then last but not least, the income statement method, right? We don't see anywhere where it displays the accounts receivable or the allowance for doubtful accounts. It doesn't appear on it. All you see is your total sales, your cost of goods sold, and whatever operating expenses that you have. So in that case, the only two things that you need to look for is the estimated amount, and once you see the key term, total credit sales, you stop there and you're only going to focus on the estimated amount. Okay? So once again, the journal will look like this for both methods. You're going to write off your bad debt expense and you're going to credit your allowance for doubtful accounts. Okay? So once again, at the end of the given period where you don't know who, you don't know when, and you don't know how much. While during the period, right, when you write off the allowance for doubtful accounts directly right from the accounts receivables, you do know who, you do know when, and you do know how much. Okay? So that's just a quick review right there. Okay? So, no questions, right? So let's go ahead and dive right into the example that we have here. So I'm going to go through a couple series of questions or scenarios, and what we're going to do is we're going to practice journalizing this, okay? So first example here is that on December 15, okay, Robert buys a total of 100 coffee mugs at $9.99 each, okay? And he places it on an account. Sales tax is 8.375%. I'm going to change this real quick just so then, because we've been practicing only 8.25%. Okay, sorry about that. Okay, so let's see what we have to do here. Okay, how do we record Robert's purchase of 100 coffee mugs?
You would start with accounts receivable.
Okay, good. The date is December 15. We got accounts receivable.
And now I know one is sales tax payable. Would the other be sales?
Yes, because we made a sales, right? We sold something.
Yeah.
Good. Yeah.
I just want to make sure that we weren't going to do, like, say, coffee mugs.
No. Remember, that only applies for perpetual.
Right, and you didn't have that up there, so that's what I figured.
Yeah, because we're not focusing on inventory anymore. We're just focusing on just recording the sale because we're going to see what happens when Mr. Robert doesn't pay. Okay, so anything that's periodic inventory, let's take that and place it on hold. Okay, so in this case, we're going to record our sales. That's the first thing you have to recognize is, what did you do? We sold something. So how much in total is the amount of sales? $999.
Sales tax is $82.42.
$999 even?
Oh yes, even. And then sales tax is $82.42.
Okay. So therefore, in grand total, how much does Robert owe me?
$1,081.42.
Okay, $1,081.42. And here, you could say that you sold 100 mugs. Okay, to Robert. Okay, good. So then, what happened next? On January 15, Robert sends a check for $25. So he's making a payment to the amount that he owes us. So how are we going to accept this or journalize this?
Would you debit coffee mugs for the 25 and credit accounts receivable?
Now, okay, if you do that, if you are increasing our coffee mugs.
Oh, that's right. Never mind.
Okay.
The head perpetual still stuck in my head.
Okay. All right. So if
Payable.
okay, now accounts payable is only when we deal with our vendors. This is a customer.
Checking,
Checking. Yes, because what did we receive?
a payment.
We received money. Yes. And how did we receive it? It's a checking. It's not cash. It's going to go directly to our checking account because we got to deposit the check. Okay? And what else?
Accounts receivable.
Right, because we're reducing the amount that he owes us because he's making a payment based on what he owes me. Okay, accounts receivable. So that's going to be Robert paid. Okay. Okay, just I'm gonna put Robert. Okay, hold on. Let's do this again. Robert made a payment. Okay. And it's for $25. Okay. So then scenario 3 says that on February 15, Robert informs us that he can no longer pay due to his circumstances. So what are we going to do here? We know exactly when, we know who, and we absolutely know how much.
Bad debt expense?
When do we use bad debt expense?
That's when you make an adjustment.
Exactly. But right now, are we at the end of the given period?
No.
No. Remember, bad debt expense is when we don't know who, we don't know when, and we don't know how much. In this case, we do know how much. We do know who because it's Robert told us he can't pay us anymore.
Well, you would debit allowance for doubtful accounts, and then you would credit your accounts receivable because you have to reduce the amount that you owe in it.
Yes. Okay. So that's correct. We gotta debit our allowance for doubtful accounts because once again, this is potential bad debt right here. Okay. We have to remove it from the people who do owe us money because we have a potential that this person may not ever pay us. Okay. And how much is the total amount since he's just saying, I can't make a payment?
$1,056.48.
Okay, so that should be the 25.
42 cents.
Okay, so that should be 25 minus out the 81. Okay, gives you 1056.42. Okay, good.
You said 25 minus 81?
Where's the 81 come from?
Yeah.
The 1081, what he originally owed us.
Oh, 1081.
Oh, sorry. I'm just doing simple math, sorry. So I just took the 25 minus the 81 to get the 56. Okay, so there we go, 1056.42. Okay. All right, and then I'm also going to make a note here. To remove Robert's accounts receivable balance. Okay. All right. Is everyone okay with that now?
Yes.
All right. So then on June 15, Robert says that he can pay $25 this month. Okay? And he sends a check. So once again, he said that he couldn't pay us this next month or this month. And then so we just placed it in the placeholder, right? Now he's saying, well, It's June now. You know what? I'm going to go ahead and make a payment to you because I actually have the money for it now. So how are we going to journalize this?
This was tricky because we already wrote off whenever he didn't pay, right?
Correct.
Okay, wouldn't you credit the allowance for doubtful accounts, the 25?
And then do what?
You would debit, well, you got a check, so checking?
Mm,
Would we put it back into accounts receivable?
correct. Yes, you would. Because right now, he doesn't owe us money. It's right now it's considered as potential bad debt. So now what we have to do is we got to reverse it just so then it validates that he still owes us money. Because right now it's in the potential bad debt account, right? So right now it's almost considered almost lost. But in this case, that's the one thing that you need to know too is that you can reverse your allowance for doubtful accounts. So in case this is June 15. So here we have to first recognize that we have to put it back into the account receivable. So I'm going to go ahead and, okay, we're going to put it back into excuse me. Okay, so we're going to put the money back into the allowance account. Into the accounts receivable, right? To make it active again. Okay? Excuse me. Now, the question is, are you going to put back the whole entire balance amount or whatever he paid us?
I would say whatever he paid us.
Okay. What if he pays us next month?
So we put the total amount back in to figure out what the debt is?
Good. So we're actually going to use the total amount because in this case, right? What if he pays us next month? What if he just pays off the whole entire amount because he says he could? Then we would have to do that transaction over and over and over again. Make sense? So it's better to just do it.
Activating his account.
Exactly. We're basically reactivating his account. So in order to reactivate his account, we got to do it for the whole amount, regardless whether we know if is he going to pay us next month or not. So there you go. And then
Checking and accounts receivable.
checking and then accounts receivable, correct. So then we're going to recognize that he made a payment. So checking and accounts receivable. Okay. So once again, that is for the $25. Okay. And then we're going to recognize received payment from Robert. Okay. So here, the first part of the journal is that we wrote it off. We currently placed it as a potential bad debt. So we need to reactivate his account by placing that he owes us this grand total amount. We need to do the whole entire amount because in this case, we can't predict if he's going to make a payment next month because if he does, then we have to redo that whole entire section again. So in this case, we're just going to reactivate his entire account. Okay? Then we're going to go ahead and recognize the payment and reduce his amount once again. Okay? Everyone good here? Okay. So then, finally, on July 15, Robert files for bankruptcy and a bank collector informs you that he can no longer pay off his bill. So, how do we journalize this?
Since
Now let's look at this again. Do we know who?
Yes.
Yes, you do. So what was that, Alan? Sorry.
Well, no, what I was going to say, it's middle of the year, so we wouldn't put it in bad debt anyways.
It's also in the middle of the month as well too.
Right. So wouldn't you transfer that back to the allowance for doubtful accounts?
Correct.
It'll be for the 10/31/42.
10/31/42.
Yeah, because that's minus the 25.
Perfect. Okay. And then once again, to remove, excuse me, okay, to remove Robert's accounts receivable balance. Okay. Excellent. So any questions so far? Okay.
Wait, can you leave it there for a second? Thank you. Okay. Thank you.
No worries. Okay. So, everyone good so far?
Yes.
Yes.
All right. So then now it is finally December 31st. Your company estimates that $2,590.54 of its total 29,047,475.72 accounts receivables are to be uncollectible. Okay? Including Robert's debt. Okay? And you currently have a total credit balance of $157.62 in the allowance for doubtful accounts. Okay? So how are we going to journalize this? Melinda.
Bad debt expense.
Bad debt expense. Excellent. Good job. Okay, so once again, because one, we're reached the end of the year. Like I've mentioned before, typically you would do this towards the end of the year. So here, we're going to recognize bad debt expense. What else are we going to recognize?
Allowance for doubtful accounts.
Yes, you're going to recognize the allowance for doubtful ACCT. Okay. Now let's determine how much.
Okay, I have a question. I was actually answering this entire question except for I had my mic muted.
Okay.
So my question is this: you're going to subtract the 157.62 because it's a credits balance.
Uh-huh.
My question is Robert's debt included in the 25.90.54?
Not in the 25. It's included in the balance. Okay. Now remember, is Robert our only customer?
No.
So we had other people who owed us money but also paid us off as well. So that's why we currently have a credit balance. Okay, because up there we only had a debit balance of $1,031.42, right? What if someone paid us $2,000? Then you would have credited. So that's why we have a credit balance in the allowance for doubtful accounts. So right now, it does include it. You just need to know, but you remember, Robert's not our only customer.
Oh, yeah, I know that.
Okay, because when we're doing an estimate, this is on everybody. Now, Robert was only $1,000 out of our 29,000. Okay? So in this case, yes, it's included in the balance in the allowance for doubtful accounts.
So subtract the 157.62 from the 25.90.54,
Mm-hmm.
and that would be the amount.
Which is, bless you. Anybody? 2, 4, 3.
243292.
Okay, yes. 2,432,92. Okay. So once again, here we're gonna go ahead and just write off bad debt. Okay. To write off bad debt for the year. Right? So once again, that's exactly correct, right? We recognize the estimated amount was the 2,950. I'm sorry, 2,590. Okay? We also recognize that it's the accounts receivable. So in this case, that should be the trigger word to make sure that we need to know what our account balance is in our allowance for doubtful accounts. In this case, we know we have a credit balance. Because we have a credit balance, that tells us that we must subtract this because this is what's currently in there, right? We already have $157 in the allowance for doubtful accounts. How much more do we need to get a total of the 2590? And that's, you find the difference, and that's the answer right there.
So we did the 29,475 minus the 157.
No, not the 29. 2590 54. The estimated amount and number
The 157.
minus the 157, yes, because it's a credit balance. Okay? Is everybody okay with this?
Yes.
Yep.
Okay. All right. Let's go ahead and finish up the last couple questions. So the next is the following problems are not related to problems 1 through 6. Okay, so number 7 says a company estimates that 20,000 of its 500,000 accounts receivable are uncollectible. There is currently a debit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry would be
You will debit 25,000 to bad debit expense and credit your allowance for doubtful accounts to 25,000.
okay. 25,000, let me see. So you got 20,000, right? And you have a debit balance. So yes, you add those two numbers together to get $25,000. Right? We take the estimated amount. We recognize the key word here is account receivable, so we actually care about what the allowance for doubtful account balance is. In this case, it has a debit balance. That means we already have $5,000 on the left. How do we get to a total of 20,000 on the right? You need to backtrack, or you need to add the 5,000 plus an additional 20,000 to get to 20,000 in the right side. Okay. Good. All right, question number 8. Okay, 8. Excuse me. A company estimates that 20,000 of its 500,000 total credit sales is to be uncollectible. And there's currently a credit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry should be
The amount will be 15,000.
okay. So let's take a look here. Wait. What did you say? You said 15,000?
Yeah.
No.
Wait. Let me see. He estimates.
What was that, Melinda? What's your guess?
You add them?
No.
Oh, no. This is one note. It would be 20,000. That's right.
Yes. The keyword, I even had it in bold just to kind of direct you in the right way. What method are we using here? No. Okay, so remember there's two methods under the allowance method. Balance sheet and income statement. So which method are we doing here?
The income statement.
The income statement. So the income statement, all we care about is just the estimated number and to verify the key term, total credit sales. There is no allowance for doubtful accounts that appears on the income statement. So we don't care about whatever balance there is. So in this case, all we care about is just that number, the $20,000. Okay? All right, so then question number 9. Okay, if a company estimates that 20,000 of its 500,000 total credit sales is to be uncollectible, and there's currently a debit balance of $5,000 in the allowance for doubtful accounts, how would you adjust this?
It would still be 20,000.
It'd be still 20,000 because the key word that we're looking for is that total credit sales. So in this case, the answer is still 20,000. Okay. All right, let me give you guys a second to catch up right here. Okay. All right. Now, question number 10 says a company estimates that 20,000 of its 500,000 accounts receivable is to be uncollectible. Okay, and there currently is a credit balance of $5,000 in the allowance for doubtful accounts. How do we record this adjustment?
Now this one would be 15,000.
Yes, right, because this time we have to look for those three things. The estimated amount, which is 20,000. The key word here is accounts receivable, so that indicates that we're using the balance sheet method. So therefore, we do care about whatever balance there is in the allowance for doubtful accounts. Right now, there's currently a credit balance. So if there's a credit balance, that should indicate to you that we need to subtract because we already have stuff on the right side. How much more do we need to get to 20,000? That's our end goal, right? The estimated amount is our end goal or our end balance in the allowance for doubtful accounts. So if we already have 5,000, how much more do we need to get to 20? And the answer is 15,000. Let me just double check. Yep, that's it for this one, okay? All right, any questions?
Go to number 9 real quick for me.
This one? So once again, the journals are going to look identical. The only difference that you're going to be looking at is whether you're using the balance sheet method or the income statement method.
I think I got mixed up with one of my problems and I was watching. Can you scroll up to 8? Oh, okay, never mind. I got it.
Okay. All right. So once again, we're going to take a look at this again on Thursday. And again, once again, when we do our review session, this is definitely something that you want to not, I mean, it's just an exercise. So once again, as long as you can utilize that concept where you're understanding that if you can recognize those three things, those three key factors, that should be good enough. Because again, you guys, we're not going to be looking at the profession of being an accounts receivable. You're not in charge of collecting debt. You're just the accountant, or even you're just the bookkeeper. So for this particular scenario, I think just knowing those little techniques is just going to help you get by. Now, if you really want to know why this happens, then go ahead, feel free, and go, look into chapter 10.1 when you go in depth to the reading. Go through that, and maybe you can find a little more details into the book as well. If not, you can always look up videos on particularly why we write off bad debt. Why is it something that we need to do? But a general rule of thumb is just when your customers just don't pay you. Simple as that. Okay? So if there's no questions right now, it is exactly 3 o'clock. So, yeah, let's go ahead and take a break, 20-minute break. So